Hello there. The active fund management industry is one of the biggest and most lucrative industries in the world. According to the Boston Consulting Group, it made profits in 2014 of $102 billion. And yet, only a tiny fraction of actively managed funds succeed in outperforming their benchmarks with any degree of consistency. So why should that be? Well, Charlie Ellis, the investment author and consultant, believes there's a direct link between the sheer number of active fund managers and their poor performance. When Ellis left Harvard Business School in the early 1960s, he was one of only 2 students to enter the fund management industry.
The 2 of us went to Wall Street. The next year there were 3 or 4. By the time a decade had gone by, there were 50 or 100 coming in every single year. There's been a flood of extraordinarily ambitious, talented, well-educated, knowledgeable people coming into investment management. And as a group, those individuals, now a couple 100,000 of them all over the world, all competing for trying to figure out what the price of every single security ought to be, have done a very good job of figuring out what the prices really ought to be. And the chance of doing better than all the others has gotten less and less and less. But the fee has stayed high. So that incremental fee is hard pressed to earn its way with the incremental return.
When Charlie Ellis started work, there were fund managers who really did add value. That was because they had access to information that others didn't. But things are very different now.
And the problem for most people, I think, is they just don't recognize, not paying attention to, how very many people there are who use the same kind of computers, have access to the same kind of staff, have Mike Bloomberg's wonderful system for gathering data and information any way you want it, use the same securities analysis and same securities research, get the same information from all the companies because regulators require it, so that they're par equal, par equal, par equal, par equal, and a whole bunch of different really important factors that 50, 40, 30 years ago really differentiated the winners from the others. But now it's not a differentiation because everybody has it.
Charlie Ellis believes that slowly but surely both institutional and retail investors are realising that active fund management isn't worth the expense. He also suspects that, privately at least, active fund managers themselves are starting to acknowledge just how difficult a job they have.
It's very hard to recognize that what you're doing, what you're working at very, very hard, and you know you're talented, you know you're really talented, and you are deeply committed to it, and you get paid very well for doing it. And people look to you with great admiration and respect for your facility in the field. Very hard to say, you know, what we're doing just doesn't work.
Thank you to Charlie Ellis for that insight, and to you for watching. Until next time, goodbye.